Hi everyone, welcome back to my channel. My name is Royce and I'm passionate about money. On this channel, I cover personal finance topics and help make personal finance easy to understand. I'm sure many of you are wondering if there are legal methods to reduce your taxable income and pay less taxes. The answer is yes, and in today's video, I'll be sharing 6 methods that you can consider for reducing your taxable income. First of all, you need to ask yourself if you know how much your taxable income is. If you know, great, you're already halfway there. If you don't know, here's a quick summary. Personal income tax generally applies to your salary, and it doesn't matter whether you're employed by a company or if you're a freelancer. This also includes bonuses but excludes CPF contributions. It also includes other income sources like rent. You will then be eligible for tax reliefs, which will reduce your taxable income. The resulting amount is commonly referred to as chargeable income, which is what the Inland Revenue Authority of Singapore (IRAS) used to calculate your taxes for the current year. We also use a progressive tax structure in Singapore. The higher you earn, the more you get taxed. Do note that there is a limit to the amount of tax relief you can receive in a year. Currently, it is capped at $80,000. Method number 1, CPF top-ups. The easiest way to reduce your chargeable income is to top up all the retirement accounts in CPF. Why? This is because you are eligible for a dollar-for-dollar tax relief for cash top-ups contributed through voluntary CPF top-ups. You can enjoy tax reliefs of up to $7,000 on cash top-ups to your special account (SA) and a further $7,000 tax relief on cash top-ups to your loved ones (SA). This allows you to potentially lower your chargeable income by up to $14,000. As a result, you may fall into a lower tax bracket and enjoy tax savings. However, this only applies up to the current full retirement sum (FRS) of $181,000. If your SA is already at this amount, you won't get any tax reliefs for additional contributions. Alternatively, you can choose to top up your MediSave account up to the basic healthcare sum of $54,500. But do note that your funds will be locked up and can only be used to pay your medical expenses or integrated shield plan premiums. I'm a huge proponent for the last CPF top-up scheme, which is putting the cash in the Supplementary Retirement Scheme (SRS) account. The amazing thing about SRS is that you're able to use the funds in there for investments, killing 2 birds with 1 stone. In recent years, the number of investments that you can make with your SRS have been expanding, and now includes robo-advisors like StashAway, which makes this relatively easy for beginners. Now, CPF also guarantees a 4% return on both your SA and MediSave account. So in summary, if you're not comfortable investing funds yourself, I would suggest you to top up your SA or MediSave account and receive the guaranteed 4% return. Method number 2, have children. Not only do you get an attractive package from the government baby bonus, you can also get a whole slew of tax reliefs or rebates. Firstly, you can claim the qualifying child relief, where you're able to claim $4,000 per child, $7,500 if your child is handicapped. IRAS will automatically pre-fill your child relief on a 50-50 sharing basis between mum and dad, so no need to fight. Secondly, you're eligible for the Parenthood tax rebate for $5,000 for the first child, $10,000 for the second child, and $20,000 per third or subsequent child. Do note that this isn't a deduction from taxable income. It is a straight up rebate of your income tax bill, so if you keep on producing children, you may never need to pay a single cent in income tax. But of course, you may have to compensate in other areas. Now, the following reliefs are only applicable to mothers. Tax-wise, it's generally more advantageous to be a mother. Sorry fathers, childbirth is really hard, so please support your wives. Firstly, mothers get the Working Mother's Child Relief if they're currently working. The tax relief will be 5% for the first child, 20% for the second child, and a whopping 25% for the third or subsequent child. Working Mother's Child Relief can also be claimed on the same child on whom the qualifying child relief has been made, but is subjected to a total cap of $50,000 per child. There is also the Grandparents Caregiver Relief, where you can claim up to $3,000 of tax relief if your parents are engaged in helping to take care of your children. For those working mothers who need an additional pair of hands to help out at home while they are working, you can claim twice the working levy paid for one domestic helper under the Foreign Maid Levy relief. Method number 3, serve the nation directly or indirectly. All eligible operational ready national servicemen (NSmen) are eligible to NSmen tax relief. The benefit ranges from $1,500 to $5,000 and is dependent on whether one performed NS activities in the preceding work year and whether one is a NS Key Command and Staff Appointment holder. NSmen who completed their ORNS cycle or NS Liable X regular servicemen above statutory age of service will also be given a base quantum of $1,500 of tax relief. If you are getting married soon and your husband is currently serving his NS-Man term, congratulations. You'll be eligible for 750 of NS-Man wife relief if you are a Singaporean citizen and if your husband is eligible for the NS-Man relief as well. Parents on NS-Man also get to enjoy the same amount of relief. Method number 4, take care of your parents and grandparents. If you are currently supporting your parents or grandparents, you may be eligible for parent relief. This also applies to in-laws, grandparents and grandparents' in-laws as long as they don't earn more than $4,000 a year. The amount of tax relief is also dependent on whether you stay with them and if they're handicapped. Do note that you can only claim for a maximum of 2 dependents. For example, assuming your retired parents are not handicapped, the maximum tax relief you can get is $9,000 multiplied by 2, which is $18,000 if you move in together. Otherwise, you can claim $11,000 per year, but you have to show that you spend at least $2,000 a year supporting each of them. If you have claimed parent relief or handicapped parent relief on both of your parents, you will not be eligible to claim the same relief on your parents-in-law. For those of you who are single, you can share the parent relief with your siblings. Method number 5, upgrade yourself. It is important to upskill oneself in order to stay relevant in the current economic environment. If you're currently working and taking a course that's relevant to your employment, IRAS grants relief for costs incurred at approved educational institutions. This would cover examination fees, course fees, and tuition fees. You can also claim seminar or conference fees as long as they lead to a recognized academic and professional qualification. You may claim up to $5,500 in course fee relief per annum. Lastly, help out the needy. 2020 is also a tough year for everyone. Many businesses are shutting down and companies are letting people go. If you have enough, why not consider giving your access to people who need help? Donations to an institution of public character, IPC, comes with a 250% tax deduction. This means that if you donate $10,000, you get a whopping $25,000 taken off your taxable income. However, not all registered charities are approved IPCs. You can check the charity portal on IRAS website to see if an organization is an approved IPC if you are looking at leveraging on this tax deduction method. I hope today's video is helpful if you are looking at reducing your taxes for next year's assessment. If you have any questions regarding tax reliefs, please drop me a comment below. See you next time.